Kenya is among the Sub-Saharan countries that recorded strong growth in digital technologies over the last decade. However, a new report by the World Bank says that the broader development benefits of these technologies, commonly known as digital dividends, are not growing at the same pace. Take a look. Digital technologies such as the internet and mobile phones have penetrated quickly all over the world. According to World Bank's 2016 development report on digital dividends, the number of internet users globally increased from 1 billion in 2005 to 3.2 billion in 2015, an indication that individuals, businesses and governments are more connected now more than ever. However, the expectation that increased connectivity would lead to immediate development has not been met.
Not enough people have access to the internet. Globally, there are only just over 1 billion people worldwide that still have access to fast, affordable internet broadband. That means that there are at least 6 billion people that don't have access to broadband. Access to the internet is still quite limited to a small elite. And then a second reason is because we're not yet seeing support for the analog complements to digital technologies.
Initially, there's a lot of euphoria that once you have internet, all the things will be solved. And clearly that hasn't happened, and we talked a lot in this report. And why is it not happening? So that we think that for that to happen, we need two things to work. So first is, of course, connectivity is very important, and we need to make sure that everybody is connected, and unless they are, they will be completely excluded from the digital economy. But even if we solve the access problem, we still need to do more. And what do we need to do more is that's why we talk about that for the business to take full advantage of technology, we need competition. For workers and people to take full advantage of technology, we need skills. And for government to be able to use technology to deliver services, you need accountability.
Kenya has been on the lead in East Africa towards adoption of digital technologies, with more than a half of the population having access to internet and 80% mobile phone penetration. Businesses and government have been able to leverage on such platforms for service delivery.
Kenya in particular, the large parts of Kenya, such as Turkana province, where people live lives which are largely untouched by digital technologies. The World Bank is investing with the Kenyan government to address some of these problems. For instance, we are constructing a new fibre optic cable which will run from Eldoret to the South Sudan border and then on to Juba, that will bring high-speed internet to many parts of Turkana County for the first time.
While the digital revolution has been lauded for creation of jobs, several tasks have also been eliminated, leading to reduced employment.
Digital technologies are transforming our labor market. On one side, they're creating new kinds of jobs, and on the other end, they are also destroying some jobs. But what they're making is they're making jobs more ICT intense. So now people who know how to use technology, as a teacher, you might be a better teacher than teachers who don't know how to use technology. Or if you are a driver, taxi driver, if you know how to use GPS and things, you can be a better taxi driver, more efficient, get more income. So that's the way the job markets are changing. And it is very country specific. Not in every country you have both the effects. So for many of the low income countries where digital adoption is very low, we are not seeing any job displaced because of technology. But we are seeing a lot of job created. So in Kenya, we have seen lots of freelancers who are working in the country, but they're working from home, from cafes and all sorts of places to work for large corporations in the US and others and making money. So those jobs would not have been possible without digital technology.
The World Bank report suggests that for emerging economies like Kenya to enjoy digital dividends, certain analog foundations such as regulation should be streamlined, and both the government and private sector have a role to play.
For the government, as we said, they have to work on making sure that people are more empowered, they're involved in the policy-making process, and technology can make it happen. So you need some of those traditional accountability, transparency for the technology to provide that role, and so the government has to create the space. It also has to set the right kind of competition policy and other things so that new companies can come in and disrupt the market, and so that is a very important role for setting the competition policy right. But while doing it, the private sector has a very important role to play. So one of the things we find is that even among the private firms, they do adopt technology, but on the front end, but a lot of things that are needed on the backside in terms of training people, the workers and other things are lagging behind. So we have some evidence which shows that, so let's say Brazil and US, two countries spend similar percentage of GDP on computers, but America spent 3 times more compared to Brazil in training the people who are using this computer.
Yeah, I think in terms of policies, it's really worth thinking about a mobile-first strategy. Many of the policies that have been developed in Kenya and in other African countries are not necessarily mobile-first. They may be concerned with, say, bringing a telephone to every home or a telephone to every school. But a mobile-first strategy takes quite a different approach to universal service and to the problem of bringing internet to the masses.